in the past when I'm busy and you're busy, so let's get started. Welcome to the Q2 Seneca Financial Solutions webinar. My name is Laretive, as I said, and I'm here today with my colleague and friend Ben Richards. We're going to walk through our products and how we've been going through the quarter. These webinars we're trying to run them 4 weeks after the end of every quarter, and for the opportunity for you guys to hear from us, ask some questions, gather some insight into what we're doing, and we'll try and keep it as usual fairly informal, and feel free to use the Q&A function. I hope it works to ask any questions that you might have. And it should take about 20 or 30 minutes, and plenty of time for questions at the end. This is a reminder, the spread portfolios of Seneca, 2 of the products of Seneca Australian Shares, SMA, and Seneca Australian Companies Fund, invest directly in Australian shares, and AFSL, large cap, mid cap space, and the other one will be small cap space. We also think that clients should be investing in other asset classes outside of Australia, and we use multi-manager strategies to access dollars across global equities, fixed income, and absolutely standing hedge fund strategies, and we'll cover off what we're doing with some of those strategies today. RIC meets every month and decides what goes into each one of those portfolios and oversees the entire governance. So piece for us and compliance piece. We have a new member joining the investment committee in July, Sam Espy, and we're looking to stand for the committee and even other independents and providing fantastic experience and expertise for that committee. So while Ben and I make the stock selection decisions, this is all overseeing by the RIC. Let's get cracking. So the Seneca Australian Shares, SMA, it's a investment 20 to 40 companies from inside the AFSL 200, the top 5 holders at the moment, BHP, Webjet, Macquarie Bank, Golden Minerals, and Freight Corp, and it's 31 companies in the portfolio at the moment. It's underperformed in the quarter, mainly been due to 2 reasons, and that's been underweight in bank and minimal weight in the resources sector. We think the banks are extremely expensive. They're trading on very high valuations, all-time high valuations, CBA 23.1 billion, 3.4% dividend yield, despite the fact you can get a term deposit from the bank for 4.9%. Use some sort of context. So yeah, that's really our view there. What's been thank you. Another thing is we've had a pretty good start for the month so far in August. Yeah, I think we're doing major changes in this quarter, and stocks like a rise in 24 11 out from about recent placement. So yeah, that has been the field down.
All right. So as we did last quarter, we'll just talk about a stock in focus from the large caps and the small caps shortly. And the company for this month is a company called Stanmore Resources. And what it does is steel making coal. Now, there's been a trend in the coal sector over the last few years where we've seen major miners divesting coal mines, given the commodity's kind of dirty perception, contributing to emissions and all that. And we think that's a bit of a misconception. I won't go into the full deep dive thesis, but Luke has written a fantastic article, in my opinion, on Livewire. So check that out if you're interested. But the TLDR on coking coal, we think it's an undersupplied commodity, and the tide's beginning to turn in terms of, it's been really difficult to finance a new coal mine, and it's favoured the existing producers, Stanmore being one of them. So in 2021-22, Stanmore bought some BHP coking coal mines located in the Bowen Basin in Queensland, which is a premier jurisdiction for production globally. Now these are, good quality assets. They're not just sort of bottom of the barrel assets. They've got a couple of mines in production and a couple of growth projects as well. The primary mines being South Walker Creek and Poitrel, which were opportunistically acquired for US $1.7 billion. when the coal price was a lot lower. In 2022, the Ukraine conflict sent coal prices skyrocketing, and essentially they were able to pay back the acquisition price from cash flow in 18 months. So not only was it a remarkable acquisition by Stanmore, but these are still in production. These are still relatively low on the cost curve, and we think will continue to deliver strong production numbers. And they've also got these other growth project assets that, over the next few years, we should start to see some movement on the development front there, and are kind of not included in the share price valuation at today's prices. So the chart there just kind of shows the valuation discount to peers, which is substantial, and it trades on 8 times PE or an 11% free cash flow yield, and we think fair value is above $5 compared to about $3.50 today. And just the final point, on this company is, we do meet with management of all these companies that we invest in. We know management well here, Marcelo and the team at Stanmore, and a bunch of the management teams in that Queensland area have all kind of worked at similar sort of mines in the past, including at Vale with our own Luke Laretive. So we do have, we think, good insight relative to our peers in the funds management space on a company like this. I'll just flick over and we'll talk about the Small Companies Fund next. The Seneca Australian Small Companies Fund, we launched it in October last year, and really pleased to be able to report 10.8% after fee performance in the June quarter. Remember, this is a zero management fee product as well. And that takes our since inception returns to 21%, which is ahead of the benchmark by just over 9%. So yeah, really strong numbers, and we've been appreciative of the support we've received from new and existing investors there. Just to talk to the drivers of that performance, the key contributors during the quarter, Sun Silver, which you may have heard us talk about before, but we think the fund was a cornerstone investor in this IPO. We felt it had all the right ingredients to do well. Commodity, time in the cycle, the share register, all those kind of things that we saw this company last year at some point and didn't invest in the pre-IPO round. We wanted to see a few more things de-risked, and by the time it came to market, we were quite comfortable with the project and the team there. So made an investment, and it did really well upon IPO. So it was a great result for Seneca clients. And a couple of other kind of stock specific calls. Global Data Center, GDC, sold. It has 3 assets. It sold 2 of them. It's waiting on one more sale, being AirTrunk, which has been well publicized. That's a hyperscale data center provider, and we'd expect that to go for a price tag well in excess of what was originally reported. They've got great momentum in that business and are calling for final bids by the end of August. So we should see where that number comes in at, and we still think GDC has some upside at these current share price levels. And the final contributor there, just to touch on, is RPM Global, which is a software provider to the mining industry. That's just been continuing its share price trajectory on the back of continued execution. Their profit number looks like it's going to be well ahead of last year's, and the market's kind of waking up to that story and the valuation discrepancy between RPM and some of its peers that have been taken out in that software space, as well as an ongoing share buyback program. So there's lots of really interesting stock-specific things happening in this end of the market, and you can see the alpha opportunity that is available if you can get a couple of them right. But obviously not all of them go right. So just to briefly touch on a couple of the detractors, Trajan Scientific, they had a bit of a disappointing result. They do scientific laboratory equipment, and the demand was a bit underwhelming. So that was one of my poorer calls, I'd say, Luke. And then AFG and Noble Oak as well, which we actually continue to hold both, and are quite confident in their underlying fundamentals. You can just see the changes we've made during the quarter as well there. And the top 5 as at the end of July, RPM Global talked about Global Data Center, talked about Imdex, GQG, and PointsBet. And we've kind of talked a little bit about the first four, but PointsBet is a new addition which we will dig into as our stock in focus for this quarter. So PointsBet, it's an interesting one. It's a sports and racing bookmaker in Australia and Canada. And the brand name might be familiar. It's Shaquille O'Neal ads, and it's kind of plastered everywhere. It's not something that we would have been interested in a couple of years ago, because the US business was burning a lot of money and spending heaps on advertising in a relatively competitive market, particularly the US, where they've just legalized a lot of sports betting in states, and larger companies are spending a lot of money there. But what's happened recently, and that chart kind of shows you the story really, is it's just sold its US business to a US company for Aussie $333 million, and have distributed the proceeds to shareholders. So although the pink line on the chart there shows that the share price has been going down, or it's gone down, gap down a couple of times, that's actually the capital return to shareholders from the sale of that US business. And the blue line is the actual underlying total return that PointsBet shareholders have received, which has been a lot better. So we think it's being overlooked by the market, given its current size at 175 million market cap. Combine that with some ESG aversion from some institutional investors. It is in the gambling space, and it's checkered history in terms of burning a lot of cash, particularly with its foray into the US. And it's got all the ingredients which would kind of initially lead you to discard it. But we think it's really interesting, given that the remaining business that they hold after the US business sale is Australia and Canada. The Australian business on its own is marginally profitable, and it's been doing $2 billion in turnover and is growing. And Canada is about a tenth of the size of the Australian business, and that's about break even as well, and growing very fast at about 50% per annum, which is above the market rate in Canada of 34%. So this kind of just touches on the financials and what we think is achievable for PointsBet. At a 50-cent share price, it trades on about 0.5, 0.6 times revenue, which is, if you look at comparable peer transactions, we think it's got 70, 80% upside. And just organically, we think the residual Australian and Canada business are quite valuable. They're growing faster than market, and they're at that profit inflection point where we're starting to see the numbers shine through, particularly if you look at the last quarter, where PointsBet beat their already upgraded EBITDA guidance, and had a really strong cash flow print. So we think that it's an attractive takeover target as well. And we think it's a one to keep an eye on.
I've got no questions in the Q&A at the moment, so I'll just keep pushing on in the interest of time. If you do have questions, whack them in there. I'll answer them as we go. Look, just really quickly, we touched on it last quarter, and we'll just do it again, just for those who are new. We think there's a lot of benefits to clients in investing in separately managed accounts. You get direct ownership. You get full transparency on the portfolio. You get all your dividends and your franking paid to you. All clients get to invest equally and at the same time and at the same price in the same ideas, which we think is unique and very unusual for an advice business. Certainly, we've got some flexibility around what we can do for you as well. If you've got particular ESG preferences, if you've got a particularly large holding in a sector, we can exclude and include things from our particular models to be able to make that work for you. And certainly, it's very transparent and easy way to invest. Just pushing on to the Seneca Australian Equity SMA. This is a portfolio that invests 25% in the previously mentioned Seneca Australian shares portfolio, the 20 to 40 companies, but also has a 75% allocation to other managers. So this portfolio is a way for those non-wholesale clients who want to invest with us and want to have some exposure to smalls at the same time, but aren't eligible to invest in the Seneca Australian Small Companies Fund. This portfolio has been doing reasonably well. Again, we've been overweight in the REITs, which has sort of cost us in June, but it has really started to pay in August with yields declining quite dramatically. And I think our manager performance has been pretty good on the whole. So I often have questions from people around what's the difference, or why would I invest in this over the Aussie shares? I suppose there's really two reasons. One, as I said, you might not qualify for the wholesale small companies fund, but also we aren't the only good Australian equities manager, and having a diverse range of Aussie share managers for you is certainly not a bad thing. In the global product, we've been overweight emerging markets, and that's cost us up to this point. But certainly, again, it's really started to pay in the first part of the current quarter. But most of our managers perform reasonably well. We've got a review into Lazard and Bell underway at the moment, and the main change for the quarter was we removed Fidelity Asia in favour of Platinum Asia. We really think Fidelity should have been doing better in the conditions that were available and outperforming by more, and we feel like Platinum has maybe got a better handle on things at the moment, so we've made that change. Aggressive Income's been really doing exceptionally well. We had 7 of our 8 managers outperform during the quarter. Really good set of numbers. Mutual High Yield, we're going to touch on in a sec. But the only really change there was we added the Van Eck Global Listed Private Credit Fund to add some more duration and yield to the portfolio, taking out the sort of zero yield Coolabah Australian hybrids product, which has been in the Aggressive Income for pretty much since inception, as far as I can remember. So just moving forward, I did want to touch on Mutual High Yield. This particular business was established in 2009. It's independently owned, founder-led, small team. You're going to hear, us repeat this sort of mantra over and over and over again. It's what we think makes a really good fund manager. These guys invest in structured credit, essentially, which is lending the banks money. So the Australian, we've seen here they provide, floating rate note. They invest in, corporate asset-backed bonds, residential mortgage-backed securities, these kind of things. They do quarterly distributions. They're offering a 9.3% running yield at the moment. They've only got 115 million under management, so they're really focused boutique business, not dissimilar to us. This product's done 11.75% over the last 12 months and almost 7% over the last 3 years. So it's been a fantastic contributor for us. It's in both of our aggressive and defensive income portfolios, and they're doing a fantastic job for investors at the moment. So it's the kind of thing you can get exposure to across the 2 fixed income portfolios, and certainly it is something I think that maybe is underappreciated by many clients and investors. The defensive income portfolio also had a really good quarter. We had 6 of 8 managers outperforming. The 2 they marginally underperformed. Again, Mutual High Yield had a really good quarter, so that featured. The main detractor was the US Treasuries exposure. We've got a long duration Treasuries exposure in there at the moment, trying to take advantage of declining yields. That didn't work to the 30 June, but it's certainly working now. And that position's up 5.45% in August alone. So I suspect that will be a significant contributor next time we catch up for defensive income. But again, that portfolio is doing exactly what it's supposed to do and really ticking along at the moment. The absolute return, the hedge fund strategies, really decent quarter, positive returns, which is what we're always after. Some of the trend following strategies, which have been great for us recently, struggled a little bit. And equity market neutral strategies were also, there or thereabouts. I think this strategy is kind of delivering what's true to label. It's positive returns, it's low correlation with markets. We only made one change, adding in Aspect and taking out GMO. They're probably comparable strategies. And if you want a little bit more detail on that, perhaps booking a time to have a chat with me and we can go through it. I did want to highlight Sage, and I think this is probably the most interesting slide from the multi-managers this particular quarter. this manager's been able to essentially outperform. I've got the charts here, the Sage, as well as the Vanguard Australian shares and the active peer group. They've been able to outperform those, but with very, very low correlation. So, you've been able to generate really good equity market returns from a completely different sort of Australian strategy. And they've avoided the worst of the drawdowns. The Vanguard Australian shares max drawdowns been -12. The Sage max drawdowns been -5. And the Sage product only has a 0.29% or 0.29 R squared or correlation. So it's got very low correlation to equity markets and the rest of the Australian market, but still able to deliver positive returns. You can see there in the rolling 3-month chart at the top that the blue line's going down when the other one's going up and vice versa. But you can see the cumulative impact of that over the last 3 years has been exceptional returns. So I think maybe the high headline fees, maybe the 120 positions, maybe the more complex investment strategy sometimes puts people off investing in absolute return or in hedge fund strategies. But I think this product, as well as we talked about Winton last quarter, and I'll continue to sort of introduce you guys to some of the products that we're using, kind of shows the benefits of having some absolute return or hedge fund exposure in your portfolio. And it can certainly be a positive contributor to returns, as well as a really important diversifier, particularly for those growth focused people who don't necessarily want to invest in bonds or want to invest a lot in fixed income. I know even personally, I've got an allocation to this particular strategy in line with my, largely equities exposure elsewhere. So I think, if you've got any more questions about the absolute return, multi-manager strategy or Sage in particular, feel free to book in some time, and more than happy to walk you through it. Just finally, just on some outlook stuff, reporting season's been sort of validating, I suppose, some of the many, ideas we've had and things that have been in the portfolio for a while, which is nice. I feel like sort of the truth's coming to the surface, and we've had a lot of momentum and hype built into the markets, and as a result, some of the stocks that I think maybe don't deserve to be moving have been moving. But certainly in this market, we're feeling pretty good about it. Small caps we think are going to continue to outperform. I don't think that's a counter consensus view now. Is a really good time for smalls. Declining costs of capital, declining bond yields asymmetrically benefit small companies. We're going to maintain our overweight in Asian equities. We don't have a lot of exposure to Japan at the moment. It's more sort of East Asia, China, Taiwan, India. So I think that's going to continue to pay for us, and is really starting to pay now, particularly with the US dollar sort of coming off. And I think in fixed income, we're going to keep rolling with this sort of longer duration tilt in our portfolios. We're certainly not getting carried away, but at the moment we feel like that's going to pay for fixed income to have some exposure to declining bond yields. It's really the theme across all of our portfolios. To be fair, I suppose from the thematics perspective, we're looking at quality industrials over maybe banks and iron ore miners, which are sort of the large parts of the index. And we do think that over the next 12, 24 months, it's been a hard 12 to 24 months for active managers broadly. I think that's going to swing around. Again, declining bond yields benefit REITs, infrastructure stocks, non-bank financials. So we're going to be investing in those sort of businesses. We think there's value in some of the resources names, lithium, copper, coal. They're stocks that you guys would have heard us talk about before. And certainly there's a lot of company specific, as Ben mentioned, sort of special situations or particular ideas we have around specific companies and what they're doing. So that's really what's driving our kind of thinking and positioning at the moment. I got a question here from Charles before I go into the stuff people sent me before the meeting. What's the cash holding in the fund? And with that in mind, have you used your recent 3-day drawdown? Yeah, so fortunate, look, not through any intelligence or wisdom of our part, but we obviously take monthly applications for the small companies fund. So as the money comes in the first day of the month, we're actually able to deploy it. Obviously, the major drawdown was the sort of the 2nd and then the 5th with the weekend. So we were actually just deploying as we normally do in the first 5 to 10 days of the month, the cash that came in. So yeah, we were able to do that. And I think we probably have benefited from that in the net. I don't know exactly how that will play, over the course of the month, if that's going to be a good or a bad thing, but certainly, we were able to do that, Charles. Reporting season's going well is the next. Someone asked me, how we're going in reporting season. Yep, we're going quite well so far. So I've had Credit Corp, PointsBet, IDP Education, a few things starting to move that we've been sitting in for a while and maybe have been underperforming or going sideways. Excuse me. Been going well. Happy with reporting season so far, and looking forward to the rest of it. As I've sort of said a few times, I'm quietly confident. Ben, what are you asking me? Ben Varley, do you think international small caps are on the rise? I saw the Russell 2000 overtook the NASDAQ a little in the last month. Look, we think smalls in general, jurisdiction, regardless of where they are in the world, are going to keep outperforming. So, it doesn't surprise me that the Russell's doing well. I think there's too much money tied up in large caps at the moment, and it's going to rotate out. There's too much value in the smaller end of the market, whether that's necessarily the really small end of the market or even just mid caps relative to large and mega cap. Another question we had during someone sent through was, is the US going to go into recession, or is the market going to crash? Look, understandable question, I suppose. Straight answer is no. Doesn't seem likely on the available information to me. I don't think that we're going to have a recession because bond yields are declining. GDP rates are more predictable and steadier, even if they are lower, still positive. It looks like a really good time to invest for me, and I'm not too concerned about the last couple of days, and I think it'll kind of work out in the wash, and it's more to do with hedge fund positioning and unwinding this Japanese carry trade with the 25 basis point increase in Japanese rates. It's got nothing to do with the average investor, to be honest. Fees. Someone asked me about fees during the last couple of days. All the SMA product is free for Seneca advised clients. If you want me to be your advisor, I charge 1% per annum plus GST. If you've got a lot of money or you're looking for particularly low absolute returns, say like sub 5%, we can certainly tweak those fees down a bit to be a bit more reasonable, given the expected returns are going to be lower. I don't want to rip you off too much, and you don't get any brokerage or anything like that on the SMA products. It's all included. If you want access to the small companies fund, that's kind of outside that remit. It's a zero fee product anyway, but we do charge a 20% performance fee, and I don't charge advice fees for client on top of that or anything like that. We just kind of have that off to one side. So that's kind of how the fees work. If you want to access our products through another advisor, the only one you can do that is the Seneca Australian Shares SMA, and that's got a 45 basis point fee on it, and you pay them on top of that. So you pay us and you pay them, your other advisor, and the small companies funds are open to everybody who's a wholesale client, so you can go to town there. How long have we been in business for? We've been in business 77 years, coming up in September. The company's owned by John Bailey and myself primarily. We own about 85%, and the remaining staff, Vic, Ben, own the balance of the 15. Our long-term plans are keep growing, keep trying to improve every day. I really enjoy what I do. I think Ben enjoys it mostly, it's a good place to work and good way to spend our time. So nothing's really going to change there, and just keep plugging away. Jake, when you are assessing prospective fund manager inclusion for an asset class, what are the key attributes we look for? I think at Seneca, we sort of have a bit of a core view, I suppose, and it's the way we run our business, Jake, and it's the way we think other good businesses are run, and that is they're owner operated. They're really focused on what they're doing. They've got a lot of skin in the game, and they're really engaged in a particular niche in the market, and not necessarily trying to do 1,000 different things at a huge institution with a product in every asset class and 15 BDMs. It's just, to us, those businesses are inefficient. We don't think you need huge teams to run really good investment portfolios. In fact, we think that decision making is more nimble, more accurate, more incentivized to be accurate when you've got a really small, highly accountable, highly aligned and invested team. So that's the way that I'll continue to run Seneca, and it's the kind of values I want our staff to kind of espouse. And certainly when we're choosing other managers, that's exactly how I would expect them to run their business in their own way, but with those kind of things aligned. So I think that's probably across all the asset classes, that would be the overriding theme. Now, is it possible, are there other good products that aren't run by businesses like that? Sure. Will we occasionally invest in them? Sure. It's not carte blanche, but certainly that's a key way, or a key marker for us of what a good fund manager may look like.
What about just things like returns and volatility and data? How do we decide that?
It's probably a good question, Benny, but I think having good numbers is important. I think having a clear strategy and being really disciplined in that strategy and not constantly chasing the hottest trends is really important as well for a manager. So it's important to stick to your knitting, stick to what you're good at, stick to what works over 5-7 years, not worry about what's going to work over 5 or 7 months. And I think that's really important as well. So data is important, and it's important to demonstrate your expertise, but it doesn't always work for you in a short period of time. All right. Well, look, thank you very much for your time. We're 4 minutes over, so I apologise for that. If you do want to catch up individually, more than happy to sit down with you anytime. You can just book a meeting on the website with me, or just send me an email, give me a call, and more than happy to do that. Otherwise, thanks again for your attendance, and I look forward to catching up next quarter.